Hello fellow traders. In technical analysis, continuation patterns like flags and pennants are essential tools for traders. They allow us to identify points where the market's pausing, but likely preparing to continue in the direction of the established trend. Over the course of this video, we'll unpack how to recognize these patterns, why they form, and how to trade them effectively. Today we're going to get into flags and pennants, continuation patterns to know, by Pajama Trader. Give this a like and subscribe. Let's get into it. What are continuation patterns? Continuation patterns form when prices trend strongly, pause briefly, and then resume the same direction. Rather than signaling a reversal, these patterns represent short-lived periods of consolidation. Once the consolidation ends, the original trend usually reasserts itself. Continuation patterns tell us that the prevailing market trend has simply stopped to take a breath. Instead of a reversal, this pause gives traders a chance to realign before the price moves further in the same direction. Flags and pennants are among the most reliable of these signals. The flag pattern. A flag forms after a dramatic price movement, which acts as a flagpole. This is followed by a rectangular consolidation where prices drift sideways or slightly against the trend. The pattern is completed once the price breaks out in the same direction as the flagpole, confirming the continuation. A flag is characterized by a sharp initial move, representing strong market conviction. The subsequent consolidation looks like a flag in itself on the pole. The key is the breakout. When the price is pushed beyond the resistance of the rectangle, it signals that the prior trend is ready to resume. Example: bullish flag on Intel. So I wanted to go over a couple flag patterns. Today we're looking at Intel, and the month of August is forming what looks like a bullish flag pattern. So you have the volume here leading into what would be the flagpole, and then you have more volume here that sort of holds the support, and then you have more volume to continue the up part of the flag. So essentially, to confirm that, you would look for a break beyond 24.96. Looking back on the month of April, April, you have what appears to be another flag pattern. You have the volume confirming the flagpole here, and then you have volume here, and you have volume here as well, and then you have a confirmation of it here at the 2064 area. And understanding these and how they're going to play out helps you to be able to make a move when you see these patterns and take advantage of the profits. Here, the Intel Corp shows a clear bullish flag. The steep upward surge creates the flagpole. The price then retraces slightly, consolidating into a downward channel. Once the price broke back above the channel, the breakout confirmed both the flag structure and the continuation of the bullish momentum. And this is a real-world example that demonstrates how a bullish flag plays out. The first leg upward is extremely strong, showing demand for the stock. The small downward sloping consolidation provides traders with the clear breakout levels to watch. Once those levels were exceeded, the bullish continuation was confirmed. The pennant pattern. The pennant resembles a flag, but one key difference is, instead of a rectangle, the consolidation takes shape of a small symmetrical triangle. The convergent trend lines show decreasing volatility as traders wait for the next breakout, like the flag, but the breakout usually occurs in the same direction of the prior move. Pennants compress price action even more tightly than flags, forming triangles with converging lines. They show that buyers and sellers are in a temporary balance after a strong surge. Breakouts tend to happen abruptly, catching momentum traders who positioned early in the move. In a bullish pennant, the market surge upward to make the flagpole. As the momentum cools, the highs come down slightly and the lows come up to meet them, forming a tightening triangle. During the breakout, heightened volume confirms that the bull trend is continuing. In this pennant pattern, it highlights the power of price compression. Instead of sliding sideways like a flag, the market funnels into a tight range, and then the breakout that follows is usually explosive, as traders waiting on the sidelines pile in when the resistance breaks. Trading flags and pennants. Trading these patterns start with identifying the breakout. For flags, confirmation comes when the price pushes through the top of the consolidation channel. For pennants, it comes when the price breaks above the narrowing triangle. The breakout should ideally be supported by strong volume. Price targets are often estimated by projecting the size of the flagpole, while protective stops are usually placed just outside the consolidation zone. When setting price entries, patience is essential. Many traders wait for the confirming breakout alongside an increase in volume, which strengthens reliability. The beauty of the flags and pennants lies in their symmetry. The flagpole often mirrors the distance of the move, giving traders a measurable price target. Key takeaways. Flags and pennants are continuation patterns that help traders recognize pauses within strong trends. They provide measurable entry points and profit targets, also in stop levels. With careful confirmation through price action and volume, these setups become among the most reliable indicators in a trader's toolkit. The main idea is straightforward. When you see a flag or pennant, you're actually seeing the market resting before another move in the same direction. By using these patterns, traders gain both structure and confidence in timing their entries. Thanks again for watching.